Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Marriott International Inc. Annual Report. Marriott International offers a diverse range of businesses and services to cater to various customer needs. At the top end of the spectrum are luxury brands such as JW Marriott, the Ritz-Carlton, and St. Regis, which provide high-end accommodations and exceptional service. The company also operates several mid-range hotel chains, including Marriott Hotels, Sheraton, Westin, and Renaissance Hotels, which offer comfortable stays at affordable prices. Additionally, Marriott has a portfolio of budget-friendly options like Courtyard by Marriott, Fairfield by Marriott, and Spring Hill Suites by Marriott. Beyond hotels, Marriott provides residences, timeshares, and yachts for rent or ownership. The company's licensing agreements also enable it to operate under various brand names, including Design Hotels and Protea Hotels Marriott. Furthermore, Marriott has partnered with other companies, like MGM Resorts International, to offer exclusive experiences through the MGM Collection with Marriott Bonvoy. In recent years, Marriott has expanded its offerings to include more affordable and flexible accommodation options, such as Aloft Hotels, AC Hotels by Marriott, Moxie Hotels, and Element Hotels. The company's Apartments by Marriott Bonv and Sonder by Marriott Bonv brands cater specifically to extended-stay travelers or those seeking apartment-style accommodations. Overall, Marriott International's extensive portfolio of businesses and services allows it to meet the diverse needs of its customers, from luxury seekers to budget-conscious travelers. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what may cause Marriott International Inc.'s stock price to increase. Marriott International Inc.'s stock price has increased significantly over the past year due to several factors. One major reason is the company's strong financial performance. With a steady rise in revenue and net income, investors have become increasingly confident in the company's ability to generate profits. Another factor contributing to the increase in Marriott's stock price is its strategic expansion plans. The company has been actively acquiring new properties and brands, expanding its global presence, and increasing its market share. This move has not only boosted investor confidence, but also provided a significant growth opportunity for the company. Additionally, Marriott's focus on digital transformation and customer experience has also contributed to its success. By investing in technology and enhancing its online platforms, the company has been able to improve operational efficiency and provide better services to its customers. This shift towards digitalization has not only improved the company's bottom line, but also made it more attractive to investors. Furthermore, Marriott's efforts to enhance its brand portfolio have also paid off. The company's acquisition of Starwood Hotels and Resorts in 2016 has provided a significant boost to its stock price. With a diverse range of brands under its umbrella, Marriott is now better positioned to cater to the changing preferences of travelers and investors alike. Lastly, the overall growth of the hospitality industry has also contributed to Marriott's success. As global travel continues to rise, companies like Marriott are well-positioned to benefit from this trend. With a strong brand portfolio and a solid financial foundation, Marriott is poised for continued growth and success in the years to come. Marriott International, Inc. market capitalization of $98 billion is significantly larger than the average industry peer of roughly $11 billion. This shows that Marriott International, Inc. holds a significant advantage in their industry. Marriott International, Inc. trades at a higher price-to-earnings ratio of 38 times and a lower price-to-book ratio of -31.04 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 111% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. The company has aggressively reduced its share count by more than 5%, while revenue, profits, and assets have grown. This represents a very favorable capital allocation strategy, with management materially increasing per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for Marriott Bonvoy are multifaceted. Franchise and license fees, royalty fees from timeshare properties, management fees from company-operated properties, and branding fees from residential real estate sales all contribute to the company's revenue growth. Additionally, loyalty programs, co-branded credit cards, direct digital channels, above-property sales and revenue management strategies, and marketing efforts also play a significant role in driving revenue. Furthermore, Marriott Bonvoy has seen steady increases in intangible assets, such as its brands, which have grown by 6.2% to $437 million. The company's U.S. earnings before income taxes have also shown an increase from $1,717 million in 2024 to $2,021 million in 2025. On the other hand, revenue decline is primarily driven by competition from regional, national, and international chains, as well as a decrease in accounts and notes receivable, net. The company has also seen a decrease in prepaid expenses and other by $23 million. In terms of segment revenue growth/decline drivers, Segment C has shown a steady increase, while major revenue streams have seen mixed results, with product sales decreasing and service fees increasing. Net income and profit margins experienced significant fluctuations over the years due to various factors. Initially, net income decreased due to disputes with hotel owners and increased costs from bookings through intermediaries, page 11. This trend continued as labor disputes and disruptions led to reduced demand for lodging due to natural disasters and extreme weather, page 13. The decrease in net income accelerated in subsequent years, with a 2% decline of $4 million attributed to various factors including depreciation, amortization, and other expenses increasing by 16%, page 24. The net income decreased by 9% from $3,083 million in 2023 to $2,375 million in 2024, pages 34-35. Profit margins also experienced a decline, with owned, leased, and other revenue margin decreasing from 13.4% to 12.9%, page 24. The operating income margin decreased from 16.3% in 2023 to 15% in 2024, page 34. Regional profit margins also showed a decline, with the U.S. and Canada experiencing a decrease of -34.5% to -33.6%, EMEA decreasing by -18.3% to -20.4%, and Greater China decreasing by -11.9% to -12.2%. However, some regions showed an increase in profit margins, such as APEC, which increased from -23.1% to -27.7%. Additionally, the profit margin in APEC region increased from 28.4% to 28.6%. The decrease in profit margins was also observed across various regions, with U.S. and Canada decreasing by 11.3% to 10.9%, EMEA decreasing by 23.8% to 21.2%, and Greater China decreasing by 33.7% to 31.9%. Overall, the fluctuations in net income and profit margins can be attributed to various factors including disputes with hotel owners, labor disputes, natural disasters, extreme weather, depreciation, amortization, and other expenses increasing by 16%. The regional variations in profit margins also suggest that different regions were affected differently by these factors. The company's financial performance indicates a steady increase in its ability to generate cash from its core operations. The data shows that the operating cash flow has been rising over the years, with a notable jump from $2,749 million in 2024 to $3,212 million in 2025. This significant growth suggests that the company is successfully managing its day-to-day activities and converting them into positive cash flows. As a result, it can be concluded that the company is indeed generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level has undergone significant changes over the past year. In 2025, the debt level increased by $1,757 million compared to 2024, reaching a total of $16,204 million at year-end. This increase is attributed to several factors, including senior notes issuances, and an overall rise in long-term debt from $13,138 million in 2024 to $14,995 million in 2025. Notably, the company's interest expenses have also undergone a significant change. Despite the increase in debt level, interest expenses decreased significantly by $114 million from 2024 to 2025. This decrease is evident in the interest expense figures, which dropped from -$695 million in 2024 to -$809 million in 2025. However, it's worth noting that the company's long-term debt increased, which may have led to a change in interest expenses. The data shows that interest expenses changed by +$112 million from 2023 to 2024, and another +$112 million from 2024 to 2025. This suggests that while the overall trend is a decrease in interest expenses, there are some fluctuations in the numbers. In summary, the company's debt level has increased significantly, but its interest expenses have decreased by $114 million from 2024 to 2025. The increase in long-term debt may have contributed to changes in interest expenses, but the overall trend is a decrease in these costs. The company's performance varied across different regions. The EMEA region stood out as a strong performer, with an 8% increase in net fee revenues and a 3% rise in segment profit. Similarly, the APAC region saw significant growth, with a 9% jump in net fee revenues and an 8% increase in segment profit. In North America, the U.S. and Canada region reported a modest 0.7% increase in RevPAR and a 2% rise in net fee revenues. On the other hand, some regions struggled to keep pace with the company's overall growth. The Caribbean and Latin America (CALA) region was not separately disclosed due to its relatively small size, while the Greater China region saw only a 4% increase in net fee revenues and a decline in segment profit. These underperforming regions will require attention from management to address any underlying issues and get them back on track. Management is optimistic about the company's outlook and strategy. The company aims to provide various experiences at different price points through franchising, management, and licensing, which has led to continued growth in franchised, licensed, and other properties. By 2025, the company expects to have 76-44 such properties. The loyalty program is a key driver of repeat business and revenue, and management is focused on attracting and enrolling new members. The company's brands are attractive to hotel owners due to their global scale, centralized reservation systems, marketing programs, and emphasis on guest service. However, management also acknowledges various risks that could impact the company's performance, including high competition in the industry, economic and global conditions, changes in government policies and regulations, and geopolitical disputes or conflict. Disagreements with hotel owners could also impact financial performance and growth. To stay competitive, management is investing in AI and emerging technologies. The company's asset-light business model and focus on franchising, management, and licensing are consistent with its strategy, which has driven revenue per available room, RevPAR, growth of 2% in 2025. Management expects to continue returning cash to stockholders through share repurchases and cash dividends. The company's liquidity needs will be met over the next 12 months and thereafter for the foreseeable future, with capital expenditures and other investments totaling $1 billion to $1.1 billion in 2026. Overall, management is confident about the company's outlook and strategy, driven by its focus on franchising, management, and licensing, as well as its investment in AI and emerging technologies. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out a significant amount of $718 million in 2025, with quarterly cash dividends declared and paid ranging from $0.63 to $0.67 per share. In addition to paying dividends, the company has also been actively buying back its own shares. In 2025, it purchased a total of 16.7 million shares for approximately $4.6 billion. This demonstrates the company's commitment to returning value to its shareholders and reducing the number of outstanding shares in the market. That concludes the financial summary for Marriott International Inc. Feel free to comment below, and I will be happy to answer them when possible.